Okay, remember that time back in 2008 when rumours started to swirl that Bear Stearns was in trouble? The rumours that sparked one of the biggest financial crises ever. Yep, I, for one, remember it like it was yesterday, and not in a good way, obviously. Well, the rumour mill is in action once again, and there are some eerie echoes of what happened back then. A global investment bank appears to be in trouble. But this investment bank is many times larger than Bear Stearns was. I am, of course, talking about Credit Suisse, the Swiss bank that has fallen on tough times. So, what exactly is going on? Well, the reason for the rumours, and I should state they are still largely rumours at this point, is twofold. Firstly, the bank's share price has almost completely cratered. It's down 21% this month alone and is trading at all-time lows. Not only that, but the stock is trading far below price to book, which means that investors think the company is worth less than its net asset value. Yikes.
This is the worst!
And it's not only the stock price that is flashing warning signs. You can also look at where the CDS spreads on its bonds are trading. Okay, so a quick bit of terminology. A CDS, or credit default swap, is an instrument that investors use in order to insure against a default on a company's debt. It's effectively a good measure of the creditworthiness of a corporate or sovereign, etc. And if you're thinking to yourself, credit default swaps sound kind of familiar, then no, you're not imagining things. CDSs were a major contributor to the crash of 2008. That's right, folks. Bankers never learn. Champagne, caviar, and cocaine rot the brain, it would seem. So, the higher the CDS spread, the more likely that the company is to default and the more costly its insurance. In the case of Credit Suisse, its 5-year CDS spread is trading at north of 240 basis points, the highest level in 10 years. And it's not as if this is unfair either. Credit Suisse's investment arm has been on the end of some hefty losses over the past few years. One of the most damaging of these was its exposure to the Archegos collapse. This was a hedge fund led by disgraced financier Bill Hwang, something which I've done a video on my main channel, which is linked to here. The TLDR there is that Credit Suisse lost a mind-boggling $5.5 billion. Holy frickin' guacamole. Now, there were, of course, a number of other embarrassing losses besides this, and there are legitimate concerns about the health of the bank's leveraged finance portfolio. Quite simply, CS's investment arm has been an albatross around the bank's neck ever since 2008. Anywho, the rumours got even worse over the weekend after CEO Ulrich Körner came out and said that the company is at a, quote, critical moment. He also said that the bank is getting ready for a massive overhaul that could see thousands of jobs cut over the next few years. Nothing to fear here, though, as the bank has a, quote, strong capital base and liquidity position in these current market conditions. I'm pretty sure I've heard lines like that before. So what's the real concern here? CS goes bankrupt and some bankers go home without bonuses. Well, not so fast. CS has a great deal of leverage, like a lot. Some estimates put it at almost $1 trillion. What happens if Credit Suisse goes under and cannot settle those contracts? Well, it effectively transfers the risk to all CS's counterparties. This could lead to another credit squeeze, except this time with a lot more leverage. Moreover, it's not just Credit Suisse that's facing trouble. Deutsche Bank also isn't looking too healthy, and its share price is trading at a substantial discount to book. Moreover, Deutsche's CDS spreads are also skyrocketing and are up 100 basis points this year already. Fear is spreading, so much so that policymakers and central bankers are starting to take notice and issue statements attempting to calm the markets, a bit like what we saw with the Bank of England as it tried to prop up the UK bond market last week. Let's hope for everyone's sake that these central banks can assuage those fears surrounding Credit Suisse and others. The last thing we need right now is another financial crisis to throw into the global macro shitstorm we find ourselves in. 2022 has been quite crappy enough, Thanks all the same. Now, with a bit of luck, these social media rumours will turn out to be largely baseless. As someone who spends more than enough time on Twitter every single day, I know all too well that a lot of crap gets spouted there. But the fears around Credit Suisse are well-founded and something you should watch very, very closely, because 2022 is almost certainly not done with us quite yet.